Diana Sescalini here, and we're going to be talking from Managerial Accounting or Accounting 1B. We're going to be covering Chapter 20 or Chapter 6, depending on which textbook version you have. So let me park myself up here in the corner. So this chapter is about variable costing for analysis and management. And we'll talk about this. Absorption costing is what we've been doing or what I've showed you up until now. And absorption costing is what we call GAAP approved. Those are the principles that we use. And we talked about that in Accounting 1A. So absorption costing is what normally happens. In absorption costing, my cost of goods manufactured is my DM, my DL, and my factory overhead, both fixed and variable. So the financial statements in absorption costing include income statement and balance sheet. So here's how my income is reported under absorption costing. Sales minus cost of goods sold equals gross profit, minus my operating expenses equals my income from operations. So what we're going to do is we're going to talk about variable costing. And variable costing is also called, what's the name? There's another name for it, I forgot. But I do the same thing. It's called direct costing. I'm sorry, here it is. In variable costing, my cost of goods manufactured only consists of my DM, my DL, and only my variable factory overhead, because it makes the assumption that my fixed factory overhead costs are really not part of the cost of goods manufactured, because I'm going to pay them regardless what I do in my actual day-to-day activities. So the difference between absorption, which is what we've been doing, and the difference between variable is how I count my factory overhead. My fixed factory overhead is part of inventory here, but it's not part of inventory in variable costing. So if we move on, here's kind of variable costing. This is an income statement from variable costing. I've got my sales, then I'm going to minus my variable cost of goods sold, and that's going to give me something called manufacturer margin. So we have a new term, manufacturer margin. And here's the formula. It's sales minus variable cost of goods sold. Then I subtract my variable, only my variable operating expenses, not my total operating. And that's going to give me contribution margin. And here is my contribution margin down here. Okay, it explains how to calculate it. Then I'm going to take all my fixed costs, which were my overhead and my operating expense, add together, and then subtract them from my contribution margin to get my income. So in reality, the only thing I'm moving around is I'm taking my fixed cost, my fixed overhead, and my fixed operating out of the picture up here and putting them down here. That's really what I'm doing with variable costing. Okay, so let's take a look at this example. Martinez Company is going to make 15,000 guitars. Let's see, are we talking guitars? I'm not sure what we're talking here. Whatever they're making 15,000 units, and they're going to sell them at $50 each. So here are the breakdown of my cost for these units. So my total number of units. Here's my total variable manufacturing. Well, that's my factory overhead. And my fixed factory overhead. Then my admin, my selling and admin are called my operating expenses. And here's what they are. So if I look at it per unit, my variable overhead is going to be $5,000. My fixed operating expenses will always be one flat number. You do not put that per unit. Only variables put per unit usually. Okay, so here we go. Here's what it looks like with absorption costing. So I sell this many guitars. Here's my cost of goods sold. And these numbers, $35. Let's back up. My cost of goods sold is my manufacturing cost because it has my fixed and my variable. And then I have my admin, my operating expenses, and there's my income from operations. So let me, and this looks very simple and easy. But when we get to looking at variable costing income statement, it looks a lot different, even though the end number remains the same. Okay, and that's fine and dandy. when we are doing this, when we're going to talk about that in a minute, okay? So here's my sales minus only my variable cost of goods sold equals my manufacturer margin. Then I'm going to subtract my variable operating expenses, and there's my contribution margin. Down here are only my fixed costs added together, and subtract that, and I still get the same answer. So here's what you need to know. This is on the next slide. When units manufactured equal units sold, income from operations will be the same. What that's saying is, this is showing that I made $15,000 and I sold $15,000. So here is the first concept to remember. Units manufactured equal units sold. Income from operations will be exactly the same under both methods. This is the end of video 1 for this chapter. We're going to start video 2 next on alternatives.